All right, welcome back to the Educated Home Buyer, where our goal is to help you buy right, borrow smart, and build wealth through home ownership and financing. With me, Josh Lewis, mortgage professional, expert, all things finance. I mean, no, we can't really go there, but welcome to the show, Josh.
Thanks for having us back, Jeb. We are really both of us screaming in on two wheels here this week, trying to do 9,000 things here before the show starts. I didn't even have my light on. I'm sitting here in the dark, for goodness sake.
No, it often works like that. So yeah, so it's trying to get everything settled before we go live and talk for 2 hours. So for those of you who are new to the show, we do this every week. Typically every week, for 2 hours, answering your questions with regards to mortgage, real estate, some economics, some, what are our favorite hamburger spots? I mean, it can go a lot of different directions, but we appreciate you being here. We appreciate the support. So what's happened over the last week? Josh, we're going to talk about interest rates. Inventory is obviously increasing in a lot of markets. That is the hot topic for many people out there at the moment, especially the people that want to call crashes and whatever. Hey, look, we told you inventory was going to increase and this was going to be, this is good. This is healthy stuff. This is great for the housing market that I think a lot of us, even real estate agents, want to see. A more balanced market, more inventory coming on the market. Here locally, we're up just shy of 2,000 active properties in Orange County. So we're at 1,983. Last week, we were just short of 1,800. So it's about a 10% increase in property week over week, using the same day for that metric. Here in Huntington Beach, we were at 129 today. Last week, 133. But during the week, I saw inventory as high as 140 something. So properties are still coming on the market. They're still going into escrow. Nothing is changing on that front. But what I will say is there is some slowing in the market. And let's be clear on what that means, guys. Don't just read the headline. Don't just listen to that, cancel out and go. Jeb said it was slowing. It's going to, everything's changing. It is changing, but we haven't seen major changes at the moment. Slowdown just means buyers are taking a couple of more days to put an offering on a property. An example, a really good example, buyers that have been kind of on the sidelines for the last couple of weeks, if you will, kind of took a break from the market, called me on a property that they saw. We went and took a look at it. They said, "What do you think it's worth?" It's priced about right. Why isn't it selling? Well, maybe, this or that or whatever. Been on the market like a week. A week. And we had the conversation, called the agent, no offers yet. By the time we got our offer together, submitted it over, and granted, we were above the asking price on our offer, made a strong offer. The other offer had come in, or another offer had come in rather, and it was all cash. We were actually a little bit higher than that offer, but they took the all cash offer just because it was a shorter term. It was really, really clean. So just because it's taking a little bit more time doesn't mean it's entirely different, right? It's still competitive. It's still moving along, but know your market, know the inventory, know what's going on. That's going to help us. But Josh is going to talk about rates because that is one of the factors that's creeping in, that's creating, I'll quote unquote issues with affordability in some price points, which is causing inventory to rise. But keep in mind, it's also a time of year when inventory does rise. So this isn't completely out of the norm to see inventory go up. I think it's a surprise to a lot of people just because we haven't seen inventory in so long that, it's starting to come to market and people are going, whoa, things are, it's a big shift. It is a shift, but stay calm, stay cool. I'll turn off the ringer on my phone while Josh updates us on rates.
Hey, maybe I should find my phone and do the same so it doesn't bug us. But no, in terms of interest rates, they just continue to leak out a little bit worse, a little bit worse, a little bit worse. The numbers that you see in the headlines, I saw some crazy numbers. Fortune magazine posted something that the average rate was 9.875%.
On
And
what?
whoever was writing the article pulled something, didn't know what they were reading, and thought they were going to get the scoop on rates going through the roof, and it was just silly. But a lot of the stuff, consider what you are seeing. Much of what shows up in your Google feed is actually advertising. For those of you who are on the right of the spectrum and may see Fox News articles popping up in their news feed, Fox News owns a company called Credible. Credible does mortgages. So magically, whenever there is an article on Fox News about mortgage rates, it's basically a Credible advertisement to direct you into their call center and generate revenue. So it's not an actual number. There's a few different indexes out there. None of them are perfect. The Freddie Mac Primary Mortgage Market Survey is always a week behind. It will come out tomorrow, but that's the average rate on all loans purchased by Freddie Mac over the last week. So it's always, when rates are going down, it always comes out and says rates are higher than they are. And when rates are going up, it always comes out and says rates are lower than they actually are. We like the Optimal Blue Mortgage Market Index. You guys can actually search that and look at it yourself. It breaks it out into different loan types: conventional, VA, FHA, jumbo. And on the conventional loans, you can even kind of break out different credit tiers, because obviously someone with a 660 credit score is going to get a much different rate than someone with a 780 credit score. So that's a super cool tool to use. But in real terms, what does that look like today? I actually, let's do a quick share screen because I wanted to show you something.
I'll throw the link in the chat for those of you guys who are looking for it.
Perfect. So I want to show this up here. So this is the bond chart. You don't need to care about the candlesticks. The reason I want to show this downtrend here in bond prices means rates are going up. No duh, Josh. We know rates are going up. From here to here is about 0.5%. And then from here to
I can't
here,
see your cursor. There you go.
I'm on the wrong screen pointing. So from this first arrow to the second arrow is a little over 0.5%. From the next one is about 0.3%. The only reason why I showed you those arrows is this is essentially a straight line down. But at this first green arrow, we had 1, 2, 3, 4, 5 days where the market tried to recover. And we've talked about this. We're not going to see, a shift or a turn in the market, but we would expect that we would have already seen a couple of retracements before the bearish sentiment takes back over. But that's 4 or 5 days, boom, another 0.5%. Then we have 1, 2, 3, 4, 5, 6 days, boom, bearish sentiment takes over. And then we saw this week, tried to claw out a bottom, 1, 2, 3 good days. It didn't even get to the 4th day. So big picture, if you like the rate you see, lock it, because it's probably not going to be there tomorrow. We've had a few. We locked a client last Friday, and then Monday and Tuesday were better. It's a risk you have to take, but you're really just going to see a few days in here where rates are better. We are still in a bearish market. We can talk about when we see that changing. In terms of what's going to move the market to better interest rates, not back to the old interest rates, but better than where they are today, is seeing inflation numbers moderate. And we're likely to see that through June, July. We have some really hot inflation figures that will fall off for last year and be replaced by lower figures this year. So we may see the market go, oh, hey, look, inflation's coming down, and see some improvement. But then we have a couple more hot months come on. So it's probably going to be October or so before we see inflation moderating. And I don't mean going from these 8-9% reads down to 4%. I mean down to 7, and then hopefully to 6, and hopefully to 5. And sometime middle of next year, if we're back in the 4% range for inflation, the market will have concluded, hey, that was a blip there in terms of supply chains, COVID, war, all that fun stuff. But until we see that, until you see month over month, multiple months, not just one blip month, probably 3 consecutive months of inflation coming down, we're going to be looking at higher rates. Jeb and I were talking before we came on here. Want to throw this up. If you're listening to on the podcast, it won't do very well for you. But for those of you watching at home, interest rates today. So an important thing to remember, these are 0 points, 0 lender fees, and this is for your best qualified borrower, big down, great credit score above 740. The interesting thing you're going to note here is whether we're talking high balance loans or standard balance loans, the interest rates are the same. So we've got 5.125, whether it's standard balance or high balance. Usually it's about 1/8% higher for high balance. On the 15-year, I'm sorry, I copied this and didn't get these updated, but this 4.625 on the 15-year. But same thing, whether it's high balance or standard balance. FHA, VA, same thing. 4.625 standard balance, high balance, and the FHA and VA are identical. So the only thing that we're seeing that you really have much hope of getting under 5% right now, jumbo loans, which are harder to qualify, generally require bigger down payments. 5% with 0 points, 4.625 with 1 point with our best priced lenders as of today on the jumbo. Also wanted to mention, we talked on the podcast, and then we also talked on the show last week a little bit about hybrid adjustable rate mortgages. If we believe that rates in the next 3-5 years are going to come back down, then a great way to avoid paying the high rates is looking at a hybrid adjustable that's fixed for 5 years, 7 years, 10 years. So looking at that, our best price lender is a portfolio lender. They hold their loans, they make their own rules. They're 30-year, and again, interesting quirk about them, they will only do loans above the standard balance. So we would have to look at a different lender if you're looking at a standard balance loan in a lower priced area. But as long as you're into the high balance limits, 4.75 with 0 points on a 30-year fixed, and you go down to a 10.6, starts getting really attractive. 10-year fixed period, and you're under 4% with 0 points. And if you're a little bit more risk tolerant and willing to take on a 5-year, you can get that down about 3.5%. Now, again, that's not every lender. You can't call up any bank, everyone in the world, but the best and most aggressively priced portfolio lenders, that's what we're looking at today. So again, not great news. If you look at that Optimal Blue Mortgage Market Index that Jeb posted, it's going to be real similar to what we looked at there, probably a little higher, especially for FHA loans. But that's for us here in California, best qualified borrowers. If you have a little lower credit score, lower down payment, you're going to look at a little bit of a premium on that.
Good stuff. So, Josh mentioned podcast a couple times in there. For those of you guys who aren't familiar, we do a podcast that's separate from this. So this is, my channel is primarily built on housing market stuff. I talk about loan programs here and there. Podcast is primarily deep dives into specific topics. So if you don't know about it, check it out. It's on major platforms out there. Just search The Educated Home Buyer. But every Friday, this post. So if you don't have time, don't want to watch us here or listen to us for 2 hours, you can listen to this entire thing on a on a podcast platform. It will post there. Put it in 2 speed, and you're done in an hour. You get a lot of good information about buying houses. So check it out there. And more importantly, if there's something you want us to talk about in detail, let us know. Right? I mean, we know what we want to talk about, but a lot of times it's not what you want to hear as a consumer or as a potential home buyer, potential seller, or whatever. So let us know, write it in the comments now. Hey, well, this would be a great topic for us to dive into, because we're looking to record some more episodes now, and they'll be out here really soon. So that's that front. You got people out there at the moment. So what else? We've been talking for a long time, right? We're going to get to questions here in just a minute, but we've been talking a long time about what changes the market. Like, what can change the housing market to make it more balanced? And the answer is always supply, right? Supply is the answer to a lot of the problems. And I quote unquote problem there. But, and with that, demand dropping off allows that supply to build, but it always goes back to supply. More supply creates more balance. And if you get enough supply, it shifts the balance entirely, where it becomes a buyer's market. We're a long ways from that. But the reason I bring this up is because you've got higher rates, pushing affordability, which again, that puts some buyers that aren't able to purchase out of the market. Supply kind of builds a little bit there. You're going into the spring market, which is typically a time of the year when more property starts to come on the market. We're seeing that now. Now, what else could help add supply? Now, Josh and I have talked about this a little bit, and I did a video that's going to post on Friday where I talk about this a little bit too. Property taxes, right? Now, we've talked about property taxes in the past. Now, in California, you're somewhat protected to some extent because you have Prop 13. Your taxes can't increase by more than 2% per year. But if you live in another state, for example, and I'm going to bring a clip here up on my computer in a minute of something that someone sent to me. But if you live in another state, you buy a house at X price, $500,000, your taxes are based off your purchase price at some point, right? I mean, it might take the county assessor a little bit to get them to your current price. But what happens is, as homes in your neighborhood or your tract start to sell for more, your property taxes are eventually going to go up too. So there's this whole idea at the moment that the next big down leg or the next fall in housing is going to be because of property taxes going up and people not being able to afford the properties that they bought, a couple years back, or maybe even a long time ago, just because of these increases. So again, this is where I'm asking you as a viewer that live in all these states across the country, do you think that's a problem, for one? Because I'm interested in hearing your thoughts. I've asked the survey on my channel about, people have you seen your property taxes increase? And a large percentage said, yeah, that we saw them increase quite a bit. I don't know that it's enough to change the market entirely, but is it enough where some people are like, I can't afford this, or screw this, I'm out of here, I'm going somewhere where this doesn't come into play, which I don't know where that is at the moment, but does that create more supply? I mean, Josh and I had this question, or I had this question to Josh, and we were kind of bouncing it back and forth. And it's like, does it help add to supply? I think the easy answer is yes. I think it does, but how much supply and when does it happen? Because a lot of times property taxes aren't due. I was talking to somebody in the Austin market. The property taxes aren't really due until the beginning of next year. So they've got 8-9 months before it really is a real problem when those taxes have to be paid or what have you. So just interesting, things that we're thinking about here that could create more balance in the market. Josh, anything you want to add on that one?
No, in terms of the property taxes, it's definitely an interesting thing, and it's fun for you and I to bat it around and start looking at how different states handle it. Because in California, we're unique among all 50 states with Prop 13, that you're limited to 2% annual increases in your property taxes. So home values can go nuts like they have the last 2 or 3 years, and it doesn't really impact the equation. But you dug in and did the research, and again, interesting to think most states, because they don't have Prop 13, they have homestead laws where some or a portion of your home value is sort of exempted from
Correct.
this run up in property taxes.
But
But
you
that
also have
does
to be a primary owner for those, right? As an
primary
investor, you
owners.
don't get
So
that.
as an investor, you don't get those protections.
Right.
So fortunately for investors over the last few years, not only have prices and therefore property taxes gone up, their rents have been going up. But it impacts the calculus. There's a lot of unintended consequences, not only of conscious decisions, but of just market forces and how they play out. We wouldn't have thought that rates going up would decrease the number of sellers coming to market. Now it seems as though we've seen a few of those sellers get off the fence, the ones that were expecting or hoping that home prices were going to continue going up 15-20% a year and they would just hold on. Now that there seems to be a little bit of moderation along those lines, we definitely are seeing a little bit of a change in that. But it's interesting. The thing that I can say is it is all interesting. We're looking at data, looking at it week after week after week. And in terms of all of this, are we seeing more supply come to market? Absolutely. So you want to look at the charts and you want to see where we get back to normal, what normal looked like pre-pandemic, which was still tight, well less than 6 months. Until we get to the 6-month level, it's still going to be a seller's market. I think everyone from realtors to buyers, everyone but sellers are going to be pretty happy that it's not nearly as strongly a seller's market. It's been very difficult for professionals on the buyer side and for buyers. So I think we all welcome some normality from that end.
No, agreed 100%. I mean, it is, we want normal just as much as the next person. And with that, I'm going to address a question that we're going to get at some point tonight, and I'm just going to reference them back to this point in the video. Should you buy right now? If more inventory is coming to the market, rates are up, should you wait? Right? And my answer is going to be depends on your situation. Right? You've got to be, Josh and I have talked about this, a little bit more cautious in this environment just because prices have run up so fast. Rates are up. If I were a buyer at the moment and I'm still looking at property, my wife is honestly, she's online more than I am looking at property. We're in a position where it makes sense to move if we can find the right property because we've got 3 growing boys, we're in 2,000 square feet, just under 2,000 square feet in the house. It makes sense to buy the property because we know that next property we're going to be there for an extended period of time. And so that's going to lead me into, if you're buying in this market, have a longer term time horizon, right? It just insulates you against any, potential moves in the market. And the market is going to go down at some point, right? It's not always going to go up. Want to be clear. Housing prices don't always go up. As much as people comment on my videos and say that's what I say, that is not the truth. They don't always go up. So longer term time horizon allows that. Not stretching yourself, money in the bank, all those are good things. So if you are a buyer, you find the right property, great, fantastic, move forward. But if you're somebody buying a property, it's not the right one, but you're thinking rates might go up, just this one will do for now. Maybe that's not it. Maybe you just wait a little bit because we are starting to see a little bit more supply. And with that, you might see home prices continue to move sideways to up a little bit. I don't think you're going to see personally any big pullbacks in prices. I don't think so. I'm not seeing it at the moment. Even homes that are sitting on the market a little bit longer, instead of 5 days, they're now sitting on the market for 10 days. We're not seeing crazy things. We're seeing homes that, that have price reductions. Those are homes that should have had price reductions regardless of any market, just because they're overpriced to start with. So just keep all of that in mind. And remember, real estate's local. So if you're in a market that, hasn't been like what we've been talking about, then just kind of gauge it, right? Don't just take somebody's advice off YouTube and go buy a house or sell a house or, make your decisions. Use all of that as, a piece of the information that you use when deciding to buy a house. So anyway, Josh, I'm going to ask you a question here.
Shoot.
I'm going to ask you a question from Dan. Dan says, are interest rates tied more to the 10-year or the Fed funds rate? Or is it potentially a hybrid of the two?
Fed's fund rate has zero impact on mortgage rates. And in theory, the 10-year has no direct bearing on mortgage rates. But in reality, the fact that the Fannie Mae mortgage-backed securities compete with the 10-year Treasury for investors. They're tied together. They don't move in lockstep, but the prices paid for mortgage-backed securities are never going to get far away from the 10-year. So if you want to know what's happening with mortgage rates, you want to look at the 10-year. But one of the things we love to show, pulled up the chart many a time, is the spreads between 10 years and mortgage-backed securities can be narrower or wider. At the beginning of COVID, before the Fed jumped in and started buying mortgage-backed securities, that spread went from, on average, the last 10 years, about 1.7%. So take the 10-year, add 1.7, and that tells you what the average 30-year fixed rate is.
So let's for example, today 10 years at 2.9.
2.8 and change. It had gone
Let's just
down.
say 2.9, just to be on the high side. 2.9. That 1.7 spread would put rates today, in theory, at 4.6.
Yep.
But they're not at 4.6.
Yeah. We're seeing a spread more of like 2.2, 2.25. And the reason for that, there is always a logical reason. Investors are not willing to pay as much for mortgage-backed securities as they normally are because they're worried that the Fed is going to take their trillions with a T of mortgage-backed securities and sell them off. And the plan is that they are. The pace for the next 12 months, if they sell the 35 billion or whatever a week, is like 1.14 trillion over the next 12 months that they plan on selling off. If they do that, that could have a negative impact on the prices paid for mortgage-backed securities. So you're always looking at the interplay between those. So right now, mortgage rates are elevated relative to the 10-year over what they normally are. So the 10-year could stay level. The 10-year could get worse, and mortgage rates could get better if the market and investors concluded that it's not a problem. Either the Fed is not going to sell as many mortgage-backed securities as they say they're going to, or that the market just absorbs them. We talked last week that last year, there was about $1 trillion more of supply of mortgage-backed securities coming to the market because of all the refinances being done. Market absorbed them, no problem. Now those refinances are gone, and we have $1 trillion of supply that will replace it by the Fed taking it off of their balance sheet and selling it into the markets. So in theory, we don't have any change to the supply-demand balance, but we've seen a little back off in demand just because of that uncertainty. Once they start selling the 35 billion a week and the market gets some comfort, we could see that gap narrow, and we could go back to 1.7, 1.8. We could see it get worse. It could go to 2.5. So we want to watch the 10-year Treasury, ignore the federal funds rate in terms of mortgages. We know what Fed funds is going to do. It's going to be going up rather rapidly. All of these things are going to lead to a recession at some point. The only rational debate is when. The most aggressive people say by the end of the year. That's pretty quick. I don't believe it, but I wouldn't be shocked. Some people say middle of next year, end of next year. But we talked about last year when the Fed was not acting and they were continuing to buy mortgage-backed securities in a very strong overheated market with really low interest rates. We talked about they always wait too long to take away the punch bowl. And then when they do, they don't just take away the punch bowl, they turn on the lights and they start ushering everyone out. So short way of saying that they just slam on the brakes too hard. So this is predictable. It's happened every time we've had an overheated economy for the last 20, 30 years. The Fed comes in too late and comes in too hard, and they slow things down. So with that, Jeb, kind of a follow-up question here. Jay followed up, and I think he misunderstood what I was saying. There's no way will I believe we'll see our inflation rates moderate in 30 to 60 days. In June and July, you're going to see lower year-over-year inflation numbers. That is moderation. Does it mean it's a change? Does it mean it's coming down? It's in how they measure. They measure the month-over-month figure and average it out over 12 months. So those numbers are going to come down.
Off and a low month come on, the average goes down.
Think about it. We might get to 10% before then, and so it could come down to 9.2 or 8.9. Does it mean people are going to go, hey, fantastic, we've got inflation under control? And we also, the second part of what I said is we've got a couple of hot months coming on after that, and they're going to go right back up. So October at this point is really about our earliest hope for looking and seeing any persistent downtrend, and it's not going to come from 10 to 8 to 6 to 4. It's going to be a slow trickle down, just like we've seen the run up over the last 12 to 24 months.
Good stuff. Good stuff. So just side note, guys, 367 people on here. That's the most we've ever seen this early in the show. So thank you guys who are watching us, supporting the show. It's all good stuff. Helps us you know, accomplish goals of educating. So good stuff. Thank you guys. Wendy has a really good question here. So Wendy says, what will be affected more by higher rates? Entry level homes in the $800,000 range or higher homes in, say, the $1.5 million range? It's something I've been thinking about. And I think, I mean, the easy answer is the first time home buyers are definitely affected more by higher rates, just because they typically don't have the capital selling a property and being able to take that capital and help them buy the next one. More generally speaking, right now, I'm summarizing, but I think that is the first time home buyer gets affected the most. Now you're seeing 800,000 to 1.5. So people out there watching this going, who the hell at $800,000 is a first time home buyer? And believe it or not, here in California, states like California, where prices are high, there are a lot of first time home buyers in that price point. Now, when I started my career, I think my average price point was like $500,000. You know, I would sell 30 homes a year. The average price I sold was 500,000 because some of them were 200,000, some of them were 750. Now I haven't sold a $500,000 home in a long time. I'd love to sell a bunch of them, but they're not out there. So the lower price points get hit harder by the higher rates. But at some point you move into a bracket where it's really big money. And I'm talking millions of dollars. And it could be 2 to 4 to 6 million or whatever. And I have some friends that sell in that luxury space that really focus on that space. And inventory is a problem for them too. I mean, they have a lot of, high net worth individuals looking to still buy real estate. And a lot of them are cash, a lot of them are getting loans. But they have an advantage in the loans that they get and some of the leverage they have with banks and what have you, and being able to get different types of loans and what have you. So easy answer is the lower price points get hit first, typically speaking, because of the higher rates. So hopefully that was helpful. I know I went a long way of getting there, but
and Jeb, that
yep.
It's funny. My answer was going to be the same thing, but in a different way. So you hit the nail on the head. That move up buyer generally has more capital available to them, so they have a lower debt to income ratio, and they're making the decision for different reasons. The first time buyer is just saying, "Hey, renting no longer works for me. I want to get into the market," and they're oftentimes stretching. What I can say is on the higher end of the market, those people are generally more attuned to the markets and have a stronger feeling for where things are. I mean, for this show and for the podcast, most of our listeners are first-time buyers. There's some move-up buyers and some wealthy folks that will reach out and ask about a $2 million loan, but for the most part, it's the first-time buyer. So those people have financial advisors, CPAs. They're reading the Wall Street Journal, whatever, where they're getting their financial information. So
Hold
that
on. They're not watching TikTok?
they're not watching TikTok for their financial news. So
This is a sham, bro. How am I supposed to get rich?
well, it just depends. It just depends. Just if you go and buy Hertz stock as soon as they file for bankruptcy is the best way to do it.
That's how you do it.
So you have the two sides. Definitely the entry level buyer is more price sensitive, but the high end buyer is more opportunity sensitive. If they feel like that's no longer an opportunity or it's too much of a stretch for them, they may back away as well. But definitely agree with Jeb that the entry level buyer who's stretched already with high prices is going to be a little bit tighter. And it doesn't have to be $800,000 entry level. It's whatever entry level is in your market and whatever move up and high end is in your market.
Yeah, and understand the last thing I'll add on to that is the first time home buyer, or and this, typically the buyer with the lower price point is usually a little bit more emotional than the high net worth individual that's probably done this a couple of times or isn't necessarily counting on that property to appreciate for them to get to the next level or whatever. So there's less emotion. It's more of a business, not necessarily a business decision, but less emotional decision in those higher price points. So it either makes sense for the family and for what they want to do and where they want to live, or it doesn't. And if it doesn't, they move on to the next one. So anyway, Archie has a question here. Archie says, is there anything being done to counter Blackrock, Zillow, Redfin buyers? No, I mean, there's not really a lot that can be done, right? It's, there's only so much you can do to limit buyers, right? I mean, we're in a market where it's, the US, I mean, you come here for freedom and being able to capitalism and all of this other stuff. And so there's only so much you can do on that side to prevent them. And again, for investment companies like that, it's very much a financial decision. Does it make sense to buy this property or does it not? Now, there are, like, as an investor, these companies buying these properties in different states, they don't get some of the benefits of being a primary owner in these states, like the homesteads and what have you. So there are some consequences to them buying the property tax wise, but there's nothing to limit them, if that's what you're asking. And there's never going to be. There's a lot of money coming from big corporations, big funds funding politics and everything in between. And this isn't a political statement or a political channel or whatever, but as long as there's money feeding from those people to Congress and to people, representatives of districts and whatever else supporting, it's a market that's going to continue. It's been around forever. It's just more pronounced now because of the media and because, of how short supply there is out there in the market. So, Josh, anything you want to add on that one?
No, it's, again, if you're going to live in an open market economy, you have to allow that. There's some things, the best ways of countering it that I've seen are essentially incentives for sellers to not sell to those groups, to sell to an owner occupant, and preferably an owner or occupant who doesn't own any other real estate, so that they're not just saying they're going to owner occupy. A friend of mine, it was very high up in Wells Fargo. He's retired now, still has a lot of government connections, and I don't know that there's any hope of this happening, but what he's pushing for would be a break on the taxes on sale for any seller selling to an owner occupant versus selling to one of these big groups or just any other investor with multiple properties. And I think if we could tip the scales in favor of the occupant buyer versus outlawing or making things illegal, would be the better route to go. But it's tough, and I don't know what, if anything's going to get through.
There you go. Again, there's just not a lot. I mean, as prices continue to rise, and they probably are going to move more stagnant sideways for, some point in the future here versus go up like we've seen. But at some point, it doesn't make sense for these investors to continue to buy some of these properties. So you're going to see less of them in the market anyway. But I do think if you saw prices pull back at all in some of these markets, you're going to see they're financially, again, there's another question here asking about what happens in the stock market. Money comes out of the stock market. It's not just going to sit on the sidelines. I mean, it might in some regard, but it's always like funds are going to invest that money. Their job is to make money for their clients, to make money for themselves. Hedge funds get paid on profit, right? I mean, typically they're a 220 type split. So they're getting money when they make their clients money. So they're going to park that money somewhere. And if it's coming out of the market, it's probably not going into bonds at the moment. So it's probably going to go into real estate in some form or fashion. But it'll be interesting to see how it plays out.
You absolutely, Jeb, not for real estate investors, but for your average homeowner, there is absolutely a wealth effect in terms of your 401k. Most people aren't invested directly. They don't have a brokerage account, but almost everyone has a 401k and IRA. When that's going up and they see that balance bigger, they're more comfortable taking on other large commitments like a house, like a mortgage. So it would be reasonable to think that there will be a negative impact. It's almost comical, though, to hear people talking that we're seeing the very first signs of additional supply coming to market. We got to the point where we had less than 1 month supply. We would have to have 6 times that to get to a neutral market. So we've listed a lot of factors tonight that are pushing things in that direction. But we also, 2 weeks ago, we showed a chart that showed we have 14 million more households formed since 2008. And we have, what was it, Jeb, 2.5 or 3 million less homes built since that time. So we were building about 3.5 million homes annually, and it's like 900,000. So right now, so we have a shortage of 2.5 million. So all of these things are correct, higher rates will limit the number of buyers available. It will moderate the prices going up. And we absolutely positively need that. 15, 16, 17, 12, 9% annual inflation is not sustainable. So when you look,
Oh, shoot. I
if
put it
we
up there and I
go
deleted it.
over, well, fix it, Jeb.
I know.
If we
Sorry,
go
guys.
over a 65-year time frame and home values have averaged 4.8%, including years where they went down 10 to 15% in 2008, 2009, these numbers that Jeb showed, these don't lie. These people aren't going to decide, oh, I just don't want to buy a house. The supply demand situation cannot get fixed. So we, in a way, need these higher interest rates. As painful as it is for anyone who doesn't own yet or didn't get to refinance at the lower rates, it's better for the market that it moderates this stuff. The quicker we can get to 5 or 6 months supply, where it's a balanced market, where buyers and sellers can meet on a level playing field and come to a reasonable price. But anyone expecting that with a monstrous supply demand imbalance like we're looking at there, that we're going to see a big dip in prices in the next 2, 3, 4 years, it's not going to happen. Our best case is we moderate. Say best case for someone wanting to get into the market, you have a 10, 15, 20% correction. But what does that do? It takes us back to where we were early last summer and no more. So all of the questions, we're going to go through a bunch of questions tonight. They come up every week. Should I buy now or should I wait until prices come down? When are they going to come down? How much are they going to come down? How much have you lost in the meantime? What are you doing now? Are you renting? So a lot of questions along those lines, and we're going to go through them.
All right, good stuff. So I want to put this question back up there just because I don't know that we addressed it directly. But so if the stock market comes down, I'm going to ask you this question, Josh. You, and again, we're in a different position than some people out there, but I'm just going to, as I would anyone, you own a house, it's on a fixed rate. The stock market drops by 40%. Do you sell your house?
No,
right.
not at all.
I'm asking a question. I want you to answer. Do you sell your house? The answer is no. Okay. Do you go to the stock market and sell everything there?
Some people will.
No, I'm asking you. What are you going to do?
I'm not going to. Some people will. A lot of people will.
Right.
It's been proven over time that people sell at the worst time and buy at the worst times.
No, for sure. I mean, that's human emotion, right? People panic, immediately goes down and get out, and then it goes back. I mean, that's the natural, market reaction or what have you. But I'm literally just asking a question here because I read that statement. I think, okay, the market goes down by 40%, hypothetically, right? I mean, we're already down 10, 15% from highs, or I don't know where we were. I haven't looked at it in the last week or so, but market is down from highs. So, but the market goes down. Do I panic? I don't personally. I mean, I've got brokerage accounts. I've got money put in stocks and equities and whatever. And to be completely honest, I look at it maybe every 2 weeks, right? I don't look at it daily. Just like I don't look at my house value daily. Never really look at my house value because, quite frankly, I mean, I know the market where I'm at. So that's probably part of the reason, but I don't look at it at all. And I definitely don't panic because the market's gone down. I'm not looking to sell anything or buy anything or whatever, but I do have cash sitting on the sidelines. Market drops 40%. I can tell you what I'm doing. I'm buying more stock personally. Maybe
Chip,
buy another house. Hell, I don't know.
You're 100% correct, but I think you're looking at this from a homeowner's perspective.
Okay.
That does
That's fair.
impact home buyers. People are more comfortable with big ticket purchases when they are feeling the wealth effect. When the stock market drops 20, 30%, there's a negative wealth effect. Those people are feeling less secure about their decision making, about what they're doing. So I don't think in any way a stock market crash increases supply, but it will take out some demand in terms of people just not feeling as good about their finances.
I'm thinking more from a supply standpoint. No, demand, it definitely, yeah, people will be affected by that for sure. Especially those that are within years of retirement or whatever. Those people definitely get affected and more hurt by that. I feel like I got time on my side. I'm not worried about, the market dropping on this, equity side at all, really. I mean, for me, it's a buying opportunity, but I think about it in a different way. But I don't think it causes prices to come down, because I think sellers in those situations would probably stay put. Now when some might need the equity from their property and decide to sell, that could create some supply. Again, these are hypothetical situations, so it's really hard to say this is what happens. These are really just my opinion, Josh's opinion, and whatever. So,
Jeb, you just said something really important. Buyers can control prices going up. If buyers stop offering more for homes, they can keep them from going up. So they can cause a market to level off. Only sellers can allow a market to come down. A seller has to be motivated enough to take a loss, and it's a paper loss. So if I sell my house, if the market drops 20% in the next 12 months and I sell my house, my loss was on paper. It's just the gains from the last 12 months. But the reason why we talk about home prices being sticky to the upside is even when they're paper losses, people do not like that. They will stick their happy butts in their happy houses and wait 1 year, 5 years, 10 years until the market recovers so they can say, I didn't sell my home for less than what its peak value was. People like selling when their home is worth more than it ever has been, and they dislike selling when it's worth less. It doesn't mean that no sellers will sell. Some people are forced to. Divorce, death, job loss, just preference. I'm out of
moving,
California.
whatever.
I hate this. I'm
Relocation.
going to Texas.
Yep.
So there will be sellers that will sell, but a large volume will not choose to sell. So you have to have a massive economic event before you see home prices decrease on a major level. That's why we say in California, we had 3 major downturns before 2000, 2008, 2007, 2008, and they were all in the magnitude of about 10, 12, 15% corrections. That's what can be expected when you have a few motivated sellers selling in a down market and no buyers absorbing that. But like, I think we see a lot of questions and a lot of people asking here as though, hey, just buyers aren't going to buy. These prices have to come down. Well, that's only if sellers have to sell. Most of them don't. Some do, most of them don't. So that's why you don't see these monstrous swings. 2007, 2008 was a different animal. People hadn't put any money down. They didn't qualify for the loan. They could walk away, risk nothing but their credit, and get a cheaper, better house than the one that they owned. That is 1,000 miles from where we're at right now.
Let me give you an example. I put a property on the market this past week as a rental. Actually, somebody from YouTube reached out to me and said, hey, do you do rentals, whatever? I got a property that I want to lease out. I put it on the market. It's in Cypress, California, right? Not the best city in the world, but not bad by any means. Nice single family home, 3 bedrooms, 2 baths, 1,300 square feet, $3,500 a month. Okay. $3,500 a month. I must have had, I don't know, 100 people call me in less than 24 hours to want to see and lease this property at $3,500 per month. Now, it's probably going to end up leasing for more than we had out there just because of the attention on it. But there is so much demand on rentals. And the reason I bring this up, the numbers, the rental amount, all of that means absolutely nothing. But what I'm telling you is there's so much demand on the rental side that if you're selling your home, you're going to have trouble probably finding a rental that is less expensive than what you're selling just to rent. It might, and granted, if you have specifics or things that you want in that property and location and whatever, you're really up against a lot of people trying to find that property. It is as crazy, the rental side, as the housing, the buying and selling was, a year ago. That is what it feels like. It is. I can't tell you how many people are calling my phone and texting me and I apologize. If you're one of those people that have called or texted me and I haven't gotten back to you, it's because of the number of calls I've gotten. So just, if you're thinking of selling and you're just going to go rent something, make sure you understand your market, because it is nuts out there. Anyway, that's Southern California for you. 506 people watching. Wow. Thank you guys. So this is a good question. I'm not sure I have an answer, but how much of the problem is due to not enough supply versus buyers grabbing houses too fast due to excess cash? Do you have any stats on this? So supply is definitely the driver. I mean, that is the lack of supply is what is caused buyers to make those quick decisions about grabbing houses quickly. So it all boils down to supply to start with, because if there were more supply to start with, buyers wouldn't have necessarily had to make quick decisions to find a property. So it goes back to supply. But yeah, there was a time in the market when buyers were making, I will say, irrational decisions in some regard. I think you're going to see less of that, just because buyers are going to have more options. I told you at the beginning, what I'm seeing more of right now is buyers taking a little bit more time to write the offer on the property. You know, 3 months ago, hell, not even 3, but 6 weeks ago, property came on the market on a Friday. You had offers Saturday. Now you might get them on Monday or Tuesday, or it might even be Wednesday before you get offers, but they're still getting multiple in many cases, but it's just taking a little bit longer to get there. That is going to allow supply to build a little bit more. Buyers have options now. That's a good thing. You don't have to take the only one. You have, I can live here or I can also live here. It's not just one option. So I don't have any stats on that. I can just tell you from being an agent in the market and, dealing with buyers out there that it comes down to, the supply is what drove everybody to make those irrational decisions to start with. Josh, we asked a question earlier about property taxes, or I did. Big G's in Arlington, property tax has exploded, but saying hasn't noticed anything in these markets that, in the hot markets with regards to property taxes that's caused anyone to sell. I also talked to a top agent in Nashville today, a gentleman I met a couple years back. He's in the luxury space. So I reached out to him and just, hey, what are you seeing? Are there any limitations on property taxes in Tennessee? And he said, no, there's nothing that keeps them from going up. But what happens is they have an appraiser that goes out and appraises these properties and whatever. And it takes every 2 years or every year or whatever they assess them. And he sent me a screenshot of one. And I'll try to pull it up here in a minute. It has a property address on it, so I don't want to post that on there, but let me see if I can get it off while you're talking at some point. And it basically shows the progression of property taxes from like the last 10 years and what has happened on this particular house and gone up. But I've asked the question, well, with all that explosion, have you seen people selling because of it yet? And he's like, no, not yet. But could it be a factor, is what I asked him. He said, yeah, it could be, but I don't see it being a problem. So we're going to see as this unfolds, because obviously this takes time and, months, years to kind of really see the full effect. But I'll pull that up here in just a minute and we can look at it, because I think it's interesting for me to see, being a Californian and seeing how my property taxes have gone up in 10 years, maybe $500 or something. I mean, not even that. I don't know what they've gone up in 10 years, where these people are seeing, double digit growth sometimes.
Look it up here. I'm gonna answer one while you're doing that.
All
so
right.
I'm going to ignore some of the stuff here in Willing's question, but says, where do you see the use of automation and technology in mortgage? How will this potentially change the industry, good or bad? We have a very funny industry, especially in the current political climate, where everyone is concerned with equality. I think we all should be concerned with equality, but we have some funny decisions and outcomes in this industry. An algorithm can properly assess risk. Like we talk about rates at the beginning of the show, I showed you the rate is this, the rate is this. And yes, if your credit score is higher, it's a little bit better. Credit score is lower, loan to value, all that stuff can impact it. But an algorithm can price the risk appropriately so an investor gets what they should be getting in terms of a yield for given risk in any loan. We don't allow that. One of the big debates in our industry is, how much do we allow algorithms to do? Is there algorithmic bias in the industry? And there's no algorithm that wasn't programmed by a person. All people have biases. We would love to claim we're unbiased. And I don't mean biases like I don't like people of this color, or I don't like people that speak this language. Some of us like running, some of us hate running. Some of us love ice cream, some of us hate it. Those are all personal biases.
Hold on. There's people out there that don't like ice cream?
crazy people. They're like lactose intolerant or
What?
something. They're anti-cow.
I think even if you're lactose intolerant, you still
You
like
still
ice
like
cream.
it.
You just don't
You
get to
just
eat
don't
it.
want to risk it. So what I can say is technology has made a tremendous impact on my job in the 26 years of doing this. For those of you that remember what these things are, what paper is, we used to have files that were like a phone book, like 3-4 inches thick, and you have the thing called an ACO that would go and it would hold. You would 2-hole punch the top, and it would hold the papers in there, and we would have to like daisy chain 2 or 3 of those together. We don't have any of that. I was on another call yesterday, and we talked about how it used to be we would do a pre-qual for a borrower because it took time, effort, and energy for them to get to us and get their documentation to us. So we wanted to get the realtor, hey, here's what we think it is. We need to get the documentation to confirm and have a full pre-approval. But really, there's no need for a pre-qual because in minutes, you can get us everything we need safely, securely through a secure portal, and we can do that. So it's made the job much easier, but we have a ton more government regulation. And 50% of it is worthless and make things harder. 50% of it is necessary to prevent the things that happened in 2007, 2008. So I think our industry is always going to be hamstrung by the concerns over inequality and unfairness and bias. So the tools will continue to get better. Margins will continue to decrease because they don't need to be as high because a person, whether it's a loan officer, a processor, everyone can produce more than what they have in the past. So that's my take on technology, and Jeb now has what he was looking for.
Yeah, so I was talking about property tax. So this was in Tennessee. It was in the county right outside of Nashville. Not Franklin, but somewhere in that. I'm not sure exactly. I could look it up. But anyhow, just an idea. It shows you what property taxes did there, right? 2013, $3,900. 2021, 13,000. Now this property in 2021 was priced about 1.4, was worth about 1.4. Today they're going to list it for $2 million. So property taxes are probably going to go up again. So you just look at that and say, okay, if you're the homeowner that lives beside them that bought their house at 500,000 or whatever versus the 2 million, yours might get reassessed. Maybe not to these numbers, but it's probably going to go up, and that could cause pain for some people. So I don't know. I mean, it's really hard to say how this plays out, right? Because you just don't know people's financial positions and how these, all these different states work. There's 50 states, and hell, I know 49 of them have different ways of handling property taxes than California. They don't all handle it like California does. So I'm not familiar with how all of it works exactly. Will it cause some people to sell? Absolutely. Is it going to cause a crash? Probably not. Anyway.
And Jeb, this is a funny thing. We talk Prop 13 for those of us in California. Outside of California, you mentioned that, and no one knows what in the world you're talking about. It is highly contentious here in California. It is an imperfect solution, but it was a very real problem that people outside of California until very recently didn't experience the way we had. In the 70s, we had a boom in housing where a home that, say, your grandparents bought in the 50s for $3,000 and was taxed at like $40 or $50 a year had gone up in value to $7,000, $70,000, and has like a $1,000 tax bill. And we hear that and we go, oh, big deal. It went from $50 to $1,000. Well, they might have been on Social Security that was, $2,400 a year, and now they have $1,000 tax bill, and it was making it where elderly people were having to sell their homes. So it is a real thing, and different states are going to have to come to ways of grappling with it unless you have a big correction in home prices, which some of our viewers are hoping for.
Good stuff. Let's see here. I just saw this question, so I'm going to pop it up there because it was literally one I just saw. So, Brian, how can I remove PMI on an FHA loan without refinancing these crazy rates? I got a 2.56 interest rate when I bought my house, but I want to lower my mortgage payment. Josh, this is a problem for many people. So how can you got an FHA loan? How can you get rid of that PMI? Now, if you've got equity, can you call your lender and get it off? Does FHA do that? How does it work?
So on 30-year loans, which I don't have the numbers in front of me, so I'm pulling this out of my ear, 99% plus of FHA loans are done minimum down 30-year. And under those terms, since 2009, 2010, under Obama, HUD changed it where it will never come off for the life of the loan. Nothing can happen. You can pay that loan down to $1. It can never come off. So your option is only refinancing. So with that very good rate, it's pretty simple. 2.65 plus 0.85% if you put 3.5% down. So what does that give us? 2.625, it's like 3.475. So until 30-year fixed rates get below that by enough for it to make sense,
You got a
you're
good
not
rate.
going you're got a good rate. You're not going to refinance that loan, and you have other things that come into play, depending on if you meet the requirements for there to be tax deductibility on the mortgage insurance. If you make too much money, it's not deductible. If you make little enough, then it is. So it's a problem. So your only hope would be for HUD, who the reason why the Obama administration made that change is that the FHA mortgage insurance fund was close to going insolvent. So, like our friends in Washington always do, they put their heads together and said, hey, let's make the mortgage insurance stay on there for the life of the loan. They didn't do any research to know that FHA, primarily used by first time buyers, most of them will buy or will sell or refinance, say, in the first 10 years of ownership. So it was never going to be there for 30 years anyways. So we had a temporary program or problem that was existed from 2007 to 2014, 2015, but we put a permanent solution in place. And the way it generally works is if you look at the HUD guidelines, it says a loan originated from this time frame to this time frame is under these guidelines. So they would have to do something different than what they've done in the past and say, not only are we restoring it to the mortgage insurance going away when you hit 78% of the original loan balance, they would also have to make it retroactive to all those loans that now have permanent mortgage insurance.
Exactly. Probably not going to happen. We've been on 1 hour, 510 people watching. You guys are like, I mean, this is like awesome. I saw 526 at the height so far, or maybe even a little bit higher. So thank you guys for supporting. Thank you guys for being ever. A lot of you are here every week. So thank you for that. If you haven't already, hit the thumbs up, share it with a friend, listen to the podcast that comes out on Friday, again, of this content or even the other content we cover. That's also appreciated as well. But just wanted to say thank you guys for being here. All right. Some good questions to get to. Josh, well, we got a comment first. Maddie is down in Vegas, got a hangover, listening to us. So Maddie, go downstairs, get one of the IVs, right? You're going to get that. You're going to be rehydrated. You're going to listen to this. And I'm not sure what you're going to do with listening to us, but you're going to go get hydrated, and then you're going to be ready. You're going to be ready by 9 o'clock to go do it again. 9 o'clock, I'm personally going to be in bed, but
Jeb,
you're going to be out in Vegas, and
Jeb,
you're going to be thanking me.
You only gave Maddie half of the prescription.
Oh, cold plunge. Cold plunge is the other.
No, that's terrible. It's a terrible idea. The second half is, and there's actually like 5 steps to this. The second step is you go over to the link, you go up the escalator to the hash house, and you get one of these giant sugar bomb pancakes.
Delicious. They have one of those in San Diego too.
To absorb
Hash house and
all of
go-go.
them. Yep. So that's the second part. And the third part, and this again does not involve a cold plunge like Jeb was suggesting. The third part is large quantities of hair of the dog. Those 3 things, and you'll be good as new.
There you go. Problem solved. Maddie, get back to us next week and let us know how we worked out for you. If you died, if we don't hear from you, you're dead, and we had nothing to do with it. Let's see. So Joe has a comment, which is something that we've been addressing. Well, people will be locked in their house basically because they have lower interest rates, right? So if I have a 2.99 on my house now, that's going to keep inventory off the market because hell, I don't want to sell and go pay more for a house and pay a higher rate. So that is going to affect inventory. So good to see people out there actually understanding how that all works. Let's see, Josh, you had put a couple in here that I want to touch on. Big G's asking, any chance the SALT deductions will come back?
It
And maybe
really,
explain what the SALT deductions are.
so it's state and local taxes. So Trump came in and made some controversial, probably unnecessary changes to the tax code in 2018. And that limited your state and local tax deduction to $10,000. So your state property tax, or your state income tax, and your property taxes were the two biggest elements of the state and local tax deductions. So if you were in a high state income tax state, California, you can be up 13, 14%. So imagine you make $100,000 and you're paying 11% in California. That's $11,000 right there. So your property tax deduction just goes out the window. You cannot deduct it because you already hit the $10,000 cap. So this is true party line politics. The people impacted by this are states with high income taxes, which happen to all be blue states. So politicians from blue states are very keen to reverse this and take the cap off of state and local tax deductions. And people from other states kind of look at you and say, you're crazy, you're in a high tax state, and that's your problem. So could it happen? Yeah, there's a lot of popular support for it by people that are on the wrong side of it. But like anything, when it comes up in Washington, D.C., that we're going to change tax policy, they sort of have to make it revenue neutral. So putting that back in place, or taking the caps off of the state and local taxes, would be negative for revenue. So, and primarily for high income earners. So there's your trouble, is that the people that will benefit from repealing the limits to state and local tax deductions is the higher income earner. So my guess is no, but it absolutely could, and depending on Democratic majorities existing in Washington, D.C. for an extended period.
No, good stuff. So let's see here. Josh says, I looked at a map showing which states are more landlord friendly versus tenant. I found my state, Missouri. Missouri is
Yes,
MO?
yes,
Yeah, I
sir.
think so.
You're smart.
Is tenant favored. Would it be wise to look 90 minutes down the road in Arkansas for investment properties? So here's the thing. California is very tenant friendly as a state. Now, if you can afford to buy in California for investment properties, that you get, the appreciation, you get the benefit of owning in California in many markets. Not always, not always going to be true. There are states that offer better opportunities that are cash flow. I would worry less about tenant friendly versus landlord friendly personally, and worry more about what are you trying to accomplish, cash flow or appreciation. I mean, everybody wants both, but really, if you could only have one, that's the direction you should go, and worry less about tenant versus landlord and work on finding good tenants. Because if you get good tenants, you don't have to worry about the landlord versus tenant crap for the most part, right? There will be people always that try to take advantage of the system, but I can tell you finding good tenants is not rocket science, in searching and doing your checks and all of that good stuff, and work with people, and you won't have problems, and you'll be in good shape. So I would say go with the place that offers the better opportunity for you. Maybe it is Arkansas, or maybe it's down the street in Missouri where you're located, and don't get caught up in the headlines of tenant friendly or landlord friendly or what have you. Josh, this one popped up a moment ago, and I'm going to let you explain it because it happens on the California side a little bit. I mean, in taxes. So Pebbles, I just love saying that. Pebbles is asking, or it could be Pebbles. Pebbles sounds better, so we're going to go with that. Could you explain supplemental property taxes? Josh, what are supplemental property taxes?
So we talked a little bit earlier. In California, your property taxes are limited to a maximum increase of 2% per year. Your assessed value is limited to a maximum increase of 2% per year under Prop 13. So let's say you buy a house from someone that's owned their home for 20 years. We go back to 2000. Homes have more than doubled since 2000. So they're paying taxes. Let's use my house for an example. I paid $580 in 2003. So I believe with the 2% increases, we're up to an assessed value of about $700,000. If I sell my house, the new buyer is going to spend about $1 million more than what my assessed value is. They don't reassess the home right at closing. So when the new owner gets the home, they're going to be paying taxes at my rate of my $700,000 assessment. but somewhere 3, 6, 9, 12 months down the line, they're going to get reassessed to the value they paid for the home. And the supplemental tax bill is the difference for that interim period when they were paying my lower tax rate versus their new higher tax rate. So it can be little, it can be big. If your seller bought recently in the last couple of years, we would normally say, oh, it's not going to be that big. But if they bought 2 years ago and we've seen 35% increases in home values, you could still see a fairly large supplemental tax bill. The important thing to note, if you have impounds, so if you have your taxes and insurance included in your monthly payment, when your loan is underwritten, they're going to use your future tax rate, not the current owner's tax rate in California, which means you're making your payments. When the next tax bill comes due, they're going to pay that lower amount. There's going to be an excess sitting in your account. They're going to give you grief about saying we don't cover supplementals, but that's largely because they don't understand what they are and what you've been paying in. So for the most part, you call, say, here's my supplemental tax bill, I would like it paid. And every 12 months on your escrow impound account, they're going to do an escrow analysis, and they can't have too much or too little in there, and they may increase your payment, they may reduce your payment. So there's a chance that you have to have an adjustment at the end of the 12 months.
But it's typically not a big adjustment, just to be
typically
clear.
not a big amount, and you should not have to come out of pocket for the supplementals if you have impounds. If you don't have impounds, be ready and be aware, and your realtor or your lender can give you a very good estimate of what those supplemental tax bills will look like. We got a wonderful system to plug it in. It looks at the current assessment, it looks at what you're paying, and it tells you what you're likely to see in terms of a supplemental, so that's not a surprise for you.
Yeah, and understand it can only happen one time. You only get a supplemental tax bill typically one time when you buy the house from a previous owner. So not going to happen, every year or what have you. In California, other states, may take it a little bit differently. So just keep in mind. Brian is saying, is inventory of single family homes in Southern California still low? Are we noticing an increase in the homes market? The answer is yes. Yes, inventory is still low. Yes, we're noticing an increase of homes. Nothing crazy, nothing to change the market as a whole. Getting back to numbers that closer to what we want to see, even though they're still well below those numbers. We're still, I think as of today, we had 1,983 homes in Orange County on the market. This time last year, I think we had 25 or 2,600. That was a market last year where we were going, God, there's no inventory. Like, where is the inventory going to come from? So it's increased, but it's still below what we want to see, well below what we want to see. So hopefully that is helpful. Let's see, Josh.
Jeb, hold on. Before you move on, I want to show the chart from Reports on Housing. This is just one area, so don't get too hung up on this being true for your area. This is what it looks like. So we were, for San Diego, this is what 2019, this is how many listings there were. 2020 was lower. 2021 still lower still, and 2022 super low. Now it's trending up. The last few years we weren't seeing that much trending up. So it's likely to cross over here in the next few weeks where there's more listings available than what we had last year. But it's important to note this purple line up here, that's a low level of listings. So if we trended all the way up and got above there, we're still, for San Diego, and this is similar for Orange County, LA County, Ventura County. So almost all of California is going to look very similar. The lines would look similar here, that you're not, there's absolutely more homes on the market, but still a really low number of homes on the market. We need to see that double or triple before we start getting back to something that would resemble a buyer's market.
Yeah, and I don't know if we can actually use that chart, so that's why I pulled it off there. I know he's okay sharing it, but he's like, putting it online. I don't know. So, I will try to reach out and see if we can use more of those, because there's some good charts in there for data like this to be able to present to you guys. The only reason I have never done it in the past is because, copyright or whatever, I don't want to infringe on someone's hard work and not give them what they want out of it. So, Josh, any ideas what proportion of mortgages refinanced prior to this year?
So it's the vast majority. I don't have the number right in front of me, but in excess of 80%. When you look at the numbers, when I saw this question, I was looking for a chart that is really cool that shows the distribution of outstanding mortgages by note rate. The vast majority of loans in the US are under 3.5%, so way more than 50%. So the question that someone had brought up earlier, are people going to be locked into their homes when they have a really low interest rate? There's a risk of that. But you have to believe, for that to be true, you have to believe that inflation is here permanently and interest rates are going to be 5, 6, 7%. And I know there's a contingent of people that want to believe that. I don't think they've thought that all the way through, because they want to believe it because they think it's going to bring home prices down, which if they stayed permanently that high, it absolutely would bring home prices down. But they don't stop to think what it means for every other aspect of your life. So
Good
I
stuff.
don't think it's true. I don't think it's going to be permanent, but it's always possible.
Yeah, and so it's something I want to touch on real quick. So next Wednesday, for one, is when we, our next live. I'm going to be just leaving a conference, so the plan is to still do the show. I'll be in a hotel room, and things will be a little bit different, but we're going to do it. But the reason I brought this up is because on Sunday I go to a conference that I do every year, and basically network with some of the top agents across the country. Everybody's in real estate and or mortgage, excuse me. And we're going to be talking about what's happening in their market. I mean, that's not what the conference is about. It's about real estate and personal growth and some other things. But I'm going to have an opportunity to talk to people in a lot of markets, a lot of people that I've referred other people on here too, had the opportunity to work with. And so on Wednesday, I'm going to have a lot of information talking to people in all these different states about what's actually happening specifically in their market and be able to bring that stuff back to you. So next week's going to be good information in, having conversations like, okay, what are you seeing in your market specifically? Because we get a lot of questions. Like what brought this up was Fahid's question here. Fahad saying, what are we seeing in the Bay Area? I don't know. I'm not in the Bay Area, but I will know next week because I'll have these conversations. So next week, and if there's anything specifically you guys want to know, ask it. I will, in here, I'll ask that to these different markets and be able to bring you back some good stuff. So, but he's asking, are people still skipping inspections or appraisals, Bay Area specifically? So here's the thing. The Bay Area was skipping appraisals and skipping inspections prior to the craziness that we saw across the country. It's something that's been happening in that market for a couple of years that we as Southern California thought, why the hell would anybody do that? And up there, people put, and this might happen in your market. It's not as common here in Southern California, but, people would do all the inspections up front, all the disclosures were done up front, and they were put in the supplements on the MLS. So if you were interested in that property, you had the disclosures, you had the inspections, you had all of the stuff you needed to be able to make a non-contingent offer up front because the market was moving that quickly. I don't know that that's changed in the Bay Area. I know there's probably seeing more inventory, but that's been something that's been common for a while. It's probably less of it, but I think you're probably still seeing some of it. But I don't know specifically. I will try to get some more information on it and come back to you next week on that question. But I can tell you here in Southern California, you're going to see less of the appraisal waivers, if you will, or contingency removal on appraisal. You're going to see less of it because, again, people got more options, but that's something as a buyer. I'm not telling you to do this, but you want to be competitive in a potential, multiple offer situation. These are things that you can still do to stand out because there will be people that still do it. Maybe not everybody, but people will still do it. The market has not shifted yet, guys, into a buyer's market. So understand that just because you see a little bit more inventory, just because it's sitting on the market a little bit longer, doesn't mean you have control. And that is very, very important to understand as a buyer. Understand, your place. You are still, I'm not going to say at the mercy of the seller because it's not the right language, but just understand you are not driving that boat in many regards. It's going to be a situation where the seller still has decision making and direction of that transaction. And no, you don't have to agree to any of it, but if you want to be competitive and in a multiple offer situation, you might have to do some of these things in order for your offer to stand out.
So, Jeb, while you were talking, it made me think along these lines. In politics, talk about demographics is destiny. If a certain ethnic group is growing, if if your population is aging, it impacts things. So we've got a couple things. We talk about supply and demand. We talk about the wave of millennials coming into prime home buying age. Other things being equal, they want to buy. We know homes have been underbuilt, so there's a lack of supply. So that's the things that tell us home prices should go up. Well, they have, and they've gone up a ton. So you have an affordability issue that's exacerbated by interest rates going up. So what happens with interest rates? Do they remain elevated? Why would they remain elevated? Because inflation becomes a concern, becomes deeply entrenched. I know smart people on both sides of the equation. My preferred source, I didn't get to read his 10-page monthly newsletter breaking down his thoughts. He still is firmly in the camp that everything is deflationary over the long haul. But the Fed butchered the COVID response so badly that this could drag on longer than we think. So that's the battle that we're looking at. Jeb's talking about we're still in a strong seller's market. What has to happen for it to get to a neutral or later on to a buyer's market or a price correction or a crash? We have to see interest rates stay high and go higher for an extended period of time while the economy suffers. So you have to be rooting for stagflation. The arguments that I see here in the comments from people that are rooting for that, they seem to think that they would be immune to the things that would cause that crash. I mean, it's sort of wishful thinking. You guys have heard Garrison Keillor with Lake Wobegon days is where all the kids are above average. Well, everyone thinks their kid is above average. Everyone thinks they would escape the wrath of those things occurring and bringing home prices down. They can happen, but it would have to be stagflation, and it would have to be strong enough to overcome the demographics that we have over the next few years. So those are the numbers that we look at. This is what we sit here and analyze. So we're going to bring you the numbers. We're going to show you what they are. Right now, I don't really want to wager one way or the other. If you ask me, in 18 to 24 months, we'll be past this. Inflation will have moderated, will be higher than what we've seen for the last 10 years. Rates will be in a reasonable range, and we're probably headed for an extended period of time of relatively flat home prices, 0 to 3, 0 to 5% home price increases. But again, that's an educated guess based off of reading a lot of really smart people and knowing what to watch to see how it plays out and what will impact the market over the next 3 to 5 years.
Awesome. Good stuff. So first off, I want to give a shout out to Jennifer Lego. I'm just now going through some of the comments here because I've been talking too much and seeing that she went in and deleted a bunch of comments that were spam, obviously. And I didn't give her props at the beginning, but she's our moderator here. She does this for free. She's just a homeowner. You like the sound of that, Jennifer? She's a homeowner now that just does this for sheer joy. And I appreciate you being here, Jennifer, and doing that. So that is my props to you for doing that and getting rid of the webcams for girls and boys video chat that came up multiple times. So thank you on that front. Now, Josh, I'm trying to get some of the simple questions just to get them out of the way because there's so many in here. Let's see. Josh, any thoughts on NFTs for property? No thoughts. Nothing. Zero.
Not even interest.
No interest. No, I don't have
Zero.
any thoughts either. I guess I'm old millennial, as people call me. I'm a 1980 birth, so I don't understand the desire to have NFTs.
I don't understand scarcity of digital products. Something has to be scarce to be valuable. I don't understand the scarcity of something digital that exists on the blockchain. So I could be 100% wrong, but I do not understand it.
No, it's not wrong that you don't understand it. The question is it something we're missing here? And maybe we are. I have no idea. And I try to read on this stuff and be open because obviously if you can get in on the forefront of something that's going to explode, you want to do it, right? So if it's something that could explode, I want to be in it. And I try to read it and understand. I'm like, I don't get the desire to own it. So therefore I don't invest my money. But not to say you can't do it.
Jeb, last night I read an article on yield farming because the headline made it sound like it would make sense to me when I was done. I felt dumber for having read the article.
It often happens to me. I read books and I'm like, what the did I just read? Like, holy God, I got to read a sentence like 3 times because my mind starts drifting mid sentence. And I'm like, okay, let me go back, read it again. Oh, didn't understand it that time either. Okay, let's move on.
So, hey, here's another interesting question for someone who's commented a lot
Yep.
tonight. Jim Shrout, you guys are in SoCal, which is completely different than most other markets around the country. And in the past, I would agree 100%.
Mhm.
Currently, I agree it's very different from many markets, but not very different from all markets. How do you
Correct.
think the rest of the country will fare compared with California? So, the rest of the country, again, is also not homogenous, just like California. But what are your thoughts on that one, Jeb?
It's a tough one. I mean, so many things have changed in the last 2 years that I don't know will regress back to the mean, if you will, before. And what I mean by that is people that got fed up with the idea of California for many reasons, the politics, the whatever, the taxes driving you from California and being able to work from home, work remotely, change the environment where people didn't have to do that. People migrated for a quality of life. People, were able to get bigger houses and wanted to make the moves anyway, so they did it, and therefore they went to markets like Phoenix and Idaho and Boise and Austin and all these different markets and push prices up in some of these markets. Now the question is, those aren't different than California now, because the people that left California are now many of the people that are driving those markets, not only in house prices, but also in politics and everything. The people, what they wanted to get away from, they've created in other areas. I mean, Austin's a really good example of that. But it's tough to say, right? I mean, what happens in these other areas? I mean, I think migration, there are still people that want to leave states like California, and there's still people that want to move out of some of these other states for various reasons and move around. I don't know how it affects other states. I mean, again, I'll go back, and nobody wants to hear this, but it's supply. If you've got a lot of supply in a market, that market's probably not going to fare as well as a market that has low supply over the next couple of years. Just because if you have a lot of something, if the demand's not there, it's going to change the landscape. And in this case, housing would be that landscape that it changes. And so therefore prices could go sideways, could go down. It's, again, these are all hypothetical things because we don't know, what is going to drive the change. And so the easy answer is I don't have an answer for it, Josh. Some markets will be affected way more than others. No question. Which markets? I have no idea. It is the markets that were probably least desirable at the start of this thing, right? When people moved, again, I'm not going to insult anyway, so I'm not going to name any cities or any states or whatever. But if you move to a place that nobody wanted to live, 5 years ago, and you're still there now, and it's not growing, and there's no job growth, and there's no employment, there's no building, those areas are going to be affected, from this whole thing, from the lack of infrastructure and all of that. Those are the people that get affected. But if you're in an area that there's job growth, there's people still moving, they're booming, whatever, like in Vegas, for example. Vegas is still growing like hell. Now, could it be one of those markets that takes a back seat like 2008? Maybe it pulls back, but I don't think you see what you saw back in 2008 because there are still tons of people moving there from other areas driving up the prices. So
Well,
the
look at
easy
one
answer
of
is
the
I don't
things.
have an answer, but
Look at
some will
one of
be
the
affected
things
more than others.
for Vegas, Jeb, that's different versus now. We had a ton of Californians going out there and buying new construction homes in Vegas as investments.
Investment, second homes, yeah, for
So
sure.
we don't have nearly as much of people leaving their market and buying investment properties and relying on them having to rent. A market that comes up very frequently when you look at the list of 10 most overvalued home markets is Havasu City, Arizona. And you look at it and you go, it used to be a retirement area. You could go out there and get a home for, like, my grandpa retired out there in 96. It's like 120 grand. Nice little 1,500 square foot single story house, warm weather, lots of hospitals, all that good stuff. Well, now that same house is $700,000. So we've got multiple things here. we have an old population where a lot of them are going to pass away and the supply is going to come on the market. Some of it will just get passed down to families. Some of it goes on to come onto the market. But we also have a lot of second homes. People love going to the river. They like hanging out on Lake Havasu. So second homes, if the economy tanks, someone's going to let their house in Havasu go or sell it at a discount versus continuing to pay a mortgage, even though it's at a low rate. So those are the things you almost have to look at every market by itself. What industry do they have there? What supports the homeowners? Where did the homeowners come from? Why do they live there? What do they want? There's reasons when you see areas show up on those lists, and only time will tell.
Exactly. Only time will tell. So let's do this. I'm going to bring up a chart here in just a minute, but let's answer this. I'm going to let you answer this question real quick, Josh, because it's an easy one to answer. Should be pretty short-lived. But what's causing the layoffs in the mortgage industry with companies like Wells Fargo and B of A?
It's the cyclical nature of the business. This isn't uncommon. This happens every time you have rates go really low. Our industry staffs up to support that, and then rates go up. So we talked about the supply of mortgage-backed securities. There's going to be $1 trillion less of mortgages originated this year, probably a little bit more than that, almost $1.5 trillion. So imagine the manpower needed or not needed to do those loans. And when you look at a lot of the companies like better.com, like Rocket, that just mass hiring, to them it's nothing to lay those folks off. For a smaller company like myself, if we let one person go, that's 20% of our workforce, and it hurts. It's uncomfortable, it's painful. When Rocket lets 2,000 people go yesterday, it's more this big blob of folks. And I'm not saying they do it willy-nilly or it doesn't matter, but it is the nature of the business. Anyone getting into the mortgage business should know that work your way to the top of the food chain, because the bottom will get cleared out every time we have one of these cyclical runs. And the funny thing is, for the last 15 years, since 2008, right when everyone gets fired is when rates dip and refinances tick back up and everyone runs back into the business. So we'll see how it happens this time.
There you go. So I'm going to put this question up here, and then I think I'm going to put this question. So David has a question. What about Gen Z buyers? You should talk about them as well and do a profile on them. How many Gen Z buyers do you see in your business? So Gen Z buyers, I had to look it up because I didn't even know the ages that they were born, but they were born between 97 and 2012, which would make them, I mean, at most today, what?
25?
Yeah, 25 years old. Not many in the California market because of prices being where they are now. In some markets, yeah, you probably see more of them. But let's look at a chart real quick. And Josh and I pulled this up last week. Was it, Josh? Let's see here. See if I can find it real quick. This one. So this goes back and talks about bursts during each generation and what have you. So the millennial generation is what is driving the market at the moment. So the red line here is 2006. And the reason that is circled is because you saw a dip in birth rate, during that period of time. And then if you went and looked at a construction chart, you saw construction houses boom during that time. So there was less people coming into prime buying age and a big surplus of property, which was another problem that happened in 2006, which caused all the craziness. But what's interesting to note here is that if you look since then, essentially birth rates are continuing to go up, right? So more of these people are going to continue to become prime buying age as we progress further. Now, what's not on here is the end of Gen Z, if you will. But you can see like probably 97 through 2012, during that period of time. Well, I guess that is Gen Z right there. So 97 through 2012, it started to increase. So more of those buyers over the next 10, 15 years are going to start to become prime buying age. And, there's probably not going to be a big surplus of property coming to the market that's going to change things. So again, it's just supply and demand.
Jeb, looking at that chart, that circled baby bust there, you don't see that going forward. So all the way through 2012, I mean, you see little dips, but you don't see that big dip of 200,000 births decrease in a year. So really the only hope in this for supply demand is we've got boomers, front end of the boomers,
Yep.
54, 76 now. So, I mean, that's past median age or median lifespan. So hopefully, and we've had that question asked, are boomers dying and homes coming to market? Yes, they are. You and I just looked at one in a neighborhood near me today. I'm
Yep.
like, it's a bitchin' little house, old and lots of
Well,
deferred
it could be.
maintenance. Could be,
Yeah,
it could be a
yeah.
bitchin' little
It's
house.
not currently.
And that one is coming to market. And you looked and you pulled some comps in the neighborhood. Another one sold in the neighborhood. That was a trust sale after the person passed. So
Right.
yeah, that could bring some balance to it, but we're not going to have a baby bust, and we haven't had the big construction wave. So some of it could moderate with baby boomers selling. They're not downsizing. The big expectation when I got in the business in 96, 97, 98, 99, 2000, hey, boomers are hitting retirement age. So again, 22 years ago, that leading edge was about 54. So when you look at that, they're saying, are they going to downsize? Well, it became aging in place. No one wanted to downsize or move out of their house, especially for us in California, where they have their Prop 13 taxes. Prop 13s are theme of the day, Jeb.
They are. This is a question that I've had flagged for a little bit and going back to answer it. Sorry, Denise says, should I buy a condo now to avoid high rent, but I still need to pay more to buy than rent? $3,600 to own, $3,100 to live in a tent. No, to rent. Should I buy or wait? So $500 difference in owning versus renting. To me, that's a no-brainer in owning a property, assuming, again, all of those things that we said earlier are true. Longer-term time horizon, not stretching yourself, money in the bank. I mean, $3,600, $3,100 in rent is probably equivalent to a $3,700, $3,800 mortgage payment with all the tax advantages and benefits of home ownership. Josh is probably doing a calculation now that's going to give us a number, but I would say if that's the case, it makes more sense to buy a property, because out of that $3,600 you're going to pay on a mortgage, what, probably $700 or $800 of it a month is going towards principal, which is for savings. $3,100 at the moment is going nowhere but to the owner's property and paying down their home. And rents are likely to go up. You're in a position where you could fix a payment and maybe even refinance at some point in the future and bring that payment down if rates do come down. That, to me, all day long, you own a property. Josh,
It's almost like we've answered this question before, Jeb. No,
it is very much
100%. So the calculation I was running is how much is going to go towards principal, and we have to kind of back our way in the numbers. At least $500 is going to principal. So when you take that into account, basically it's the same as your $3,100 rent and a $500 a month forced savings account. If we flash forward 10 years and you get 4% appreciation like we have the last 65 years, the home's worth about 50% more than it is today, and you've paid that thing down 70, 80, $90,000 over that time frame. So that's how you build wealth. And Jeb also mentioned fixing your housing cost. It's not going to happen with renting. So if you have a longer time horizon, 5 to 7 years, and the numbers are that close, I would absolutely say buy.
There you go. Philly says, putting an offer in on a house right now, we put in an escalation clause with a max. Our agent wants to do escalation with no max. What do we do? You got to take the advice of your agent in many cases, but you got to do what you're comfortable with. I would say the one thing I've learned about escalations is that, occasionally they get capped out and you end up losing for one reason or another. But here's the thing. You could put no escalation. Your offer gets accepted. You find out the price. You don't have to move forward, right? You don't have to move forward with the transaction. So in one situation, you might not get the deal. The other situation, you might absolutely get accepted, but it might be at a price you're uncomfortable with. So you decide at that time whether or not you move forward. I don't know. You've got to be comfortable as a buyer to make that decision, right? Your agent shouldn't be telling you this is what you have to do. It sounds like they're giving you advice on what they feel is the best to get your offer accepted. And so, if you trust the agent and trust the process, to go with the agent. If not, go your way and see what happens and learn from doing and learn in your market and see how it plays out. I don't know that there's a right or wrong answer. It's all about what you're good with. Josh, let's see. This is, I guess, a fairly easy question to ask. Taking PMI versus putting 20% down, regardless of the area. So if you had 20% to put down, would you put it down to avoid PMI, or would you leverage the market, put less money down, pay a little bit PMI? Thoughts?
My answer is that numbers never lie. Do a side-by-side comparison of the different scenarios that you're considering and put as little down as you are comfortable with the monthly payment. When it comes to the question of mortgage insurance, it has a terrible reputation, but especially for borrowers with 10% or more down and really high credit scores and more than one borrower, most people are shocked at how low the mortgage insurance rate is. So take a look at that, get an actual quote. You would be stunned at how many mortgage loan officers will just take a guesstimate. We use Loan Sifter for our pricing, and it puts a guesstimate in there that's way too high. So we actually go into an engine that prices mortgage insurance exactly like Loan Sifter prices rates, and it brings back 8 different carriers for mortgage insurance, and it gives us the lowest rate. And for most people with good credit and a decent sized down payment, 10% plus, it's not that much. So look at both of them and just go with what you're most comfortable with. For a lot of people, it's not a question, it's not an option because they're pinned at their maximum debt to income ratio. So they have to put a certain amount down. And I guess the last thing I would say on this topic, it's counterintuitive, but generally, the rate is a tiny bit better at 85% versus 80%. The reason being is the lender requires coverage that protects them 25% against loss. So they're actually a little bit more covered with your 15% down plus the mortgage insurance you buy than you putting 20% down. So really, you just got to run a comparison, have your loan officer do it, have them get an accurate quote from a real mortgage insurance company and run the numbers for you.
Absolutely. Now, MC says, what if two bidders have no escalation clauses, infinite price? Absolutely. So I've been in the situation where I've had two buyers have two escalation clauses. In that case, it's the listing agent's responsibility to go to both of them and say, hey, what is your best price? I've got two of you guys going up. Take the escalation clause out. What is your best price? And that's how you deal with it. So that's the easy way to address it. But yeah, in theory, you are correct with that. Josh, is it smart to sell your house before a recession? Do you think a recession's coming? So I'll ask you the second part of the question first. Answer that. Do you think a recession's coming? Easy answer, yes or no.
All signs point to yes.
Okay. Do you sell your house prior to a recession?
Recessions have not proven to have a negative impact on home values. Every recession is unique, and how the economy as a whole reacts will determine that. So could it have a negative impact on home prices? Yes. Historically, it has not, other than the Great Recession, which was actually caused by housing. It didn't make housing go down. Housing plunged us into recession.
Right. Yeah, no, agreed. I did a video on this last Monday, I believe, where I actually showed you the charts from back then. Historically speaking, home prices have fared well during recessions. Obviously, there's a lot going into this recession that could be different because of the Fed getting involved and all the things, policy-wise that have come to light since the pandemic. So we don't know how it's going to react. But historically speaking, the answer is there's no effect. But I would ask you the same question I would ask anybody thinking of selling a house. Sell your house and do what? Like, what is the goal with selling your house? Is it to sit on cash because you think you're going to buy something less expensive? Or are you going to be selling anyway and moving to another market? Are you selling and going to rent? Like, why? Why are you selling? Those are the reasons and the things that you have to consider before really, regardless of recession or not. Like, why are you selling? And see if those signs or reasons are valid, and then make the decision going from there. Josh, does California home ownership cost have any effect on filing taxes? I'm not sure I understand the question. That's why I'm throwing it to you.
Well, your homeownership cost, the only thing that's going to be tax deductible is potentially property taxes, but most likely not. If you missed the question about state and local taxes, go back and cover that. So in California, high property tax or high state income tax, you're probably not going to be able to deduct your property taxes. So then you would have your mortgage interest up to $750,000, which a lot of folks have bigger mortgages than $750,000. So they're even getting capped on how much mortgage interest they can deduct. So other than that, not going to have any impact on your taxes.
There you go. That's where I thought the direction of the question was, but I just didn't. Homeownership cost. I'm assuming cost. Anyhow, anyway, I won't go into that. But Tony, what is your advice on investing in a second home at this time, and in what market would you consider yourself? So, I don't really have advice on investing in second homes. Second homes are a luxury. They're one of those things that people do because they want a place to live in another market. And so does it make sense for you to own a house in that market? I mean, that's a personal thing for most people. You got to figure out why you're buying it to begin with. Do you spend a lot of time in that market already? Or are you paying cost to live there? Those are things that you think about. I owned a second home back in the day in South Florida. And what I can tell you from my experience is it made way more sense not to own a second home and just go there on vacation and have fun. And from a cost perspective, now, if it's something you do all the time, then that's, something you need to weigh. Market, again, that's it. To me, it more sounds like you're talking about investment property than a second home, because second homes are where you want to spend your time versus, trying to figure out what is the best market. But Josh, thoughts?
If it's truly a second home, Fannie Mae and Freddie Mac, the FHFA dictated to Fannie Mae and Freddie Mac some changes earlier in the year. It used to be you had to put 10% down on a second home, but there was no change in pricing versus a primary residence. So for whatever reason, they went from no change in pricing to anything less than 25% down is about a 4-point hit. So a full percentage point at a minimum in interest rate for a second home. So a lot of people are looking more to portfolio lenders and local banks that have more competitive rates, and you're probably looking at closer to a 20% down. So not as attractive as it was even 3 months ago, but it can be a very good way of getting additional real estate if we're truly talking about a second home there.
Good stuff. Brian Espinoza, another question, gentlemen. I just bought a house and I live on a dead end street, but they're basically building 25 brand new homes right next to me. Will my value go up? So it could help you. But what you don't want to see is brand new homes go up that are priced less than the value of your home, because that could, in theory, affect your value in a negative way. But assuming they're nicer, more expensive homes, it could help your value. I mean, a buddy of mine bought a house in El Paso, Texas years ago. It's been a long time now, probably 15 years ago. And for a while, the new construction homes that they were building next to him were actually less expensive to own than the house he had already bought. And then over time, it's obviously all changed and what have you. But, I don't think you're in a market where that's going to happen. But that's what you don't want to happen, is where the newer, nicer stuff is less expensive than the one you own. But assuming they are more expensive, it should help your value. But it's not necessarily a comparable, so to speak, as far as an appraisal goes, because of the time difference, in most cases. Josh, anything on that one?
Nothing there, but we have a nice follow-up here. A regular viewer, Alex Rodoni, follows up on that question of mortgage insurance and should you do it? Is it worth it? His purchase price was $800,000 down, 15% down, 744 credit score, and the PMI was $51 a month. So the difference, 5% down on 800 would have been an additional $40,000. So to keep $40,000 back, we have a $51 difference. Now, obviously, there was a cost for the borrowing the additional $40,000, about $5-6 a thousand. So say $240 plus the 51 in MI, $300 a month versus an additional $40,000. I like the idea of having the cash as long as you can afford it. And then Melissa followed up here and says, we decided to put less down so we could offer more to be competitive. It worked and we got the offer accepted. So don't be afraid of mortgage insurance. I'm certainly not saying it's the right decision for everyone, but it can be a strategy for keeping more money in your pocket, for getting more aggressive on offers if you're in a really competitive situation. And then just staying on the topic of mortgage insurance here, Jeb, we'll do the mortgage insurance catch-all. Carrie says they paid $550 to do an appraisal to get the mortgage insurance canceled. Sounds steep, but the mortgage insurance was $200 a month, so I feel is worth it. Thoughts?
Absolutely.
Absolutely. That one's a no-brainer. In 2.5 months, you're to the positive. So fortunately, you're in a conventional loan, not an FHA where it's on there for the life of the loan, like the gentleman earlier. But again, PMI is not anything to be feared. It can be used strategically to put you into a better position.
Good stuff. AJNL. AJ, I put two letters together. I just made a new letter of the alphabet. AJNL. I did like the LMNOP thing. Fair. What is the current cause of the housing shortage for California? Still a supply shortage, building permits, question mark. What would lead to a surplus in the future? So supply shortage, the answer is yes. Cause is a number of things. One is, construction being underbuilt for an extended period of time. Another is the cost to break ground. Josh has talked about this extensively. It's $90,000 here in the state of California just to break ground on new construction because of all the permits and the fees and all the craziness that goes along with it. Not even considering, how environmentally safe and all the other, I'm not going to say garbage because I'd probably get hate mail or something. But things that go along with it. So it's just, there's so many things that go into that process that have caused construction to be on the lower side, plus available land in desirable areas where people want to live. Some of these markets, the Bay Area, like where are you going to go build in the Bay Area? You can't. So you have to go on the outskirts. Well, the outskirts are further from the Bay Area. Well, who wants to live out there? Nobody's wanted to live out there until, recently, because they had to, commute in and deal with traffic and all of these other things. So there's just been a number of reasons that it hasn't happened. And cost-wise, because it costs so much money to build these properties, it's never made sense because property values weren't increasing at these levels and what have you. And so it's just a number of things. What would lead to a surplus in the future? A surplus, that's a big, that's in California. What's a surplus look like? I have no idea. I mean, I haven't seen a surplus since like 2007 in housing, 2008, 9. So it would take a lot. It would take time and it would take a lot of building, and neither of those are going to happen quickly, in my opinion. Josh?
No, same stuff. I don't see a solution to it because on top of that, California has some of the strictest environmental regulations. So you can be building in an area that you wouldn't think would be environmentally sensitive and still run into major issues. So
then you get the coastal commission involved, and where we are here, just like so many layers, and it's all costly. Like everybody wants their piece.
Yeah.
So yeah. Another one we had start here. Josh, California versus Texas. Regarding related housing costs and lifestyles, why would one transition to and from either location? So this is an interesting question because, the California Association of Realtors, they probably still have it on their website. I'm sorry, the National Association of Realtors. So if you go to nar.org, they had this box on their website. You have to kind of dig to find it, but it showed you could put in your state or a state, and it would show you where the most people were leaving your state and going to. So migrating from your state, going to another state. And then it would also show you which state was giving you the most people with regards to migration coming back into the state. And believe it or not, the most people were leaving California and going to Texas. But guess where Texas was sending the most people? Back to California. So interesting question. But Josh, when you think of these things, why do you think people leave one and head to another and vice versa?
Let me give you an example, and I probably told this one on the show here before. My buddy, one of my best friends from college, who was our point guard, he lives in Fort Worth, and he has a brand new condo, brand new, probably 2-3 years old now. And I'm like, condo? And he says, well, stay with us when you come in. Well, you got a little condo. We can't all just shack up in there. And he goes, no, my condo is 3,000 square feet. So my house is 1,700 square feet. His condo is 3,000 square feet. His condo is worth about a third of what mine is. And it is beautiful, like beautiful. Any one of us would be happy to live there. And when we come down to it, he goes, listen, dude, he goes, I make good money. I got no state income tax. If I were in California, it's about $30,000 to $40,000 I'd be paying to the state that I don't pay here.
So you've listed property was less expensive. You get more
Yep.
bang for your buck. No
Yep.
state income taxes, right?
Yep.
So those are a couple.
So now you flip over to the other side and we go, what are your property taxes on this thing? So places assessed at like a little less than 600. Let's make it easy and say at 600. And his property taxes were over 2.5, but close to 2.5. So he was paying $15,000 a year in property taxes, which will continue going up. I'll bet in the year since I've been out there visiting, the place is worth 70 grand more. So again, another $2,000-$3,000 more in property taxes on it. So the difference is, if I do my retirement planning right and my taxable income decreases in retirement, I'm not paying a bunch to the state, and I still have my tiny little low taxes that are based on when I bought my house in 2003. His will continue going up. So he has to account for probably $20,000 a year of property taxes in retirement, where I don't. And my planning, my retirement planning, and when what is tax deferred, tax free, will dictate whether I come out ahead or not. My feeling when we went out there and looked at it, super cool. Fort Worth is an awesome city. There's some really cool stuff. For me to move, the area that we would want to be in is still 1.3, 1.4. So double his cost. So now you're talking $30,000 to $40,000 a year for property taxes in retirement. And it's not California. Like I tell everyone, everything bad that people tell you about California is 100% true. Everything that people tell you is awesome about California is 200% true. So it's a tough equation.
So I'm going to go a different direction with that question. So Josh mentioned all the tax and housing reasons, and that's what the housing cost was about. Let's talk about lifestyles. You would move to California for the weather. If you like more, less humidity, you don't like rain, Southern California is fantastic. That's why I'm still here. I'm also here because I live near the beach. I can go surf in the morning if I want. I can go ski in the afternoon. I got hikes near me. There's a lot to do, right? There's always things. I got 3 kids. It's really easy to entertain kids because there's so much to do. If I lived, depending on where you live in Texas, might be rural, might be, maybe you're in Dallas or Fort Worth or whatever and have access to that. But California offers a lot of that. So that's some of the benefit there. But the grass isn't always greener, right? It's not always better just because one reason or another. But people move for political reasons and taxes, like Josh mentioned. So those are some of the reasons that people go back and forth. But I can tell you, I've had a buddy. He went to Austin, bought a house in Austin, new construction. It was like the premier house on the lot there. I forget what he paid for it. He lasted 6 months. He kept the house, rented it out, moved back to California, and he rents in my neighborhood. So he was like, I couldn't do it. He was like, it was too hot, too humid, everything that people complain about in Texas, and he complained about leaving California or all the things in California, but he still came back. So to each his own. That's what you got to go. Let's see here. So we're at hour 55 in at the moment. So I'm going to do what I normally do. We're at 202 likes, guys. Thank you. I'm going to ask that you hit the like button there. If you found any value tonight, if you've been with us, gained any knowledge, any information, you appreciate us, you like Josh's new melon hat, matching the shirt, like my shirt, I'm going to wear it every Wednesday now. I'm like Steve Jobs. I just got 100 of these and I just wear them every day.
That means I'm going to have to get a black hat to go with my black shirt. And then if we get gray shirts, then I'm going to get gray. It's going to be a never ending cycle.
Yeah, there you go. You could be the matchy of the deal. But no, I'm going to go back to what I said at the beginning. What do you guys want us to talk about on the podcast? What do you want to hear more of on here? Is there, because a lot of times we answer questions and that's great, but that only benefits maybe a portion of the people on here because it's their question. And maybe you're not in that point or in that spot. But if there's something you want to do a deep dive in on a podcast and it could be encompassing and get, educate more people, that's what we want to hear. So if there's something you guys want us to talk about, I'd love to hear it. Josh, anything else? A lot of you guys have reached out the podcast, about it, listen to it. Every Tuesday episode covering something different, a deep dive into a topic. Every Friday, we're putting this on there for you guys to listen to in its entirety. So that's helpful. In addition to that, Josh, we've talked about, we have people reaching out now asking us about consultations and do you walk people through the buying process? And for me, it's always been kind of one of those things that's hard to touch on because I've always been wanting to educate people through here, right? And provide information. But what I found out is a lot of people ask me for my advice and then go use somebody else to do the information or their buddy or whatever. Maybe they're not in my market at all. And I can't really, it's hard for them to use me. So Josh, we're going to do this. We're going to put this up here, guys. So Josh and I are going to do consultations. If you want to have a consultation, you can reach out at those links there. I'll leave them out there through the end of the show. It's a way to get your questions answered in more detail. Here in the state of California, if you do a consultation with me, you end up using me for whatever reason, you get your money back. So it's really simple on that front, but it's more there to save us our time because we're spending a lot of time answering calls, answering emails, and not really getting anything, out of it financially. And yet it's costing us a lot of time to do it. So hopefully that's helpful. Josh, anything you want to add here as we exit tonight?
We had some important stuff.
We did.
Jeb, we have some folks that want to know how they buy the shirt, Jeb. So you're gonna have to start a store.
Oh man, I don't have a merch store. I've got a bunch of shirts here in my office though. I've got like 20 something shirts over here sitting in a box that I've done nothing with at the moment. So how about this? Next week, I will have something where I can put that up for you guys. But next week, again, tune in because I'm going to be talking to agents this week about markets, about what they're doing, what they're seeing, what they've done to help offers get accepted, all of these things that you guys can benefit from. I did this last year. It's really good stuff. So hopefully you guys find it beneficial.
Jeb,
Josh?
I have a crazy idea, and let's see what these guys think about this. No one took us up on using Volley to send us messages.
Yep.
What if you got a list of 10 or 12 of your best friends in the Buffini group in different parts of the country and did a quick Volley with them? Send them a quick, give me 5 minutes on your market. We could throw that up and play it for everyone because we are Southern California centric, but I think that might be good if everyone would be willing, or if a bunch of people would be willing to do that. And share
I can definitely do that. Yep. I will do that. I will, that'll be good stuff. So that's a good, we could have done that off air, but yeah, no, that's good. So you guys know that might be coming. I'll try to get people to do that. But anyway, 2 hours, guys. Thank you. We'll be back next Wednesday answering your questions, providing value, providing, education. So if you wouldn't mind, hit the thumbs up, follow us, subscribe, go to podcast, do all of that fun stuff. Just, hey, come live with me. It's all good.
Just a reminder, Jeb, thank you to everyone for showing up. This was far and away the biggest
520 something people, guys. Awesome. I mean, that's, I don't know if you guys understand. I mean, for me that's a big number on a live broadcast. So you guys all helped us get there.
When I tell my